Hello, and welcome to another live event from The Economist. I'm Charlotte Howard, the paper's executive editor, and we are here today to discuss recent developments in digital finance, from mobile payment platforms in India to digital currencies backed by central banks. And with me today to discuss this are two colleagues who are absolutely immersed in the subject, Wall Street correspondent Alice Fullwood and global business and economics correspondent Arjun Ramani, who has just written a special report on digital finance, which is in this week's issue. Welcome to you both, and thanks for being here. So, Alice, can you tell us what's going on here? It seems pretty clear that there has been a push in the direction of travel toward non-cash payments. Who have been the big winners from this trend over the past few years?
Yeah, so first, thanks for having us. I'm excited to get into this with you and Arjun. So as you point out, there's been a clear trajectory in every single one of these countries towards non-cash payments as a share of transactions, and in general, I think there have been sort of a few winners from this trend, which sort of really accelerated during COVID-19, during the pandemic, when people were sort of having to shop for everything from home. One group are the sort of existing big incumbent payments players. So some of those incumbents, in particular in places like the US, where Visa and MasterCard are very dominant sort of card networks. People have been using those cards more and more as payments have shifted more digitally. So, the existing incumbents have been sort of one beneficiary in some places. The other beneficiaries have been sort of all of these new exciting payment platforms that Arjun is going to tell us a lot more about in a minute. So that's places like UPI in India, Pix in Brazil, Alipay, WePay in China. Those new platforms have very quickly sort of come to be extremely dominant and very important. And the third group is probably sort of most consumers. In general, digital payments are sort of convenient, they're quick, they can be very cheap. And so it's a beneficial trend for consumers as well as some of the providers of those payments.
So at the bottom of that chart, I noted that India was there, which I was a little surprised by because it doesn't seem to tell the whole story. So Arjun, in your special report, you have a whole chapter which is about the digitization of certain emerging economies, and the QR code that's on screen now will take you right to that special report if you'd like to read it for yourself. But I was fascinated by the coverage of India and what it might tell us about the future of digital finance. It looks very different than in America or Britain. Can you explain that a bit, Arjun?
Yeah, well, thanks for having me as well, Charlotte. And it is kind of interesting that India's at the bottom of the chart. I mean, I guess what I would say is that it ends in 2021, and the usage of India's new payment system, which I'll explain in a second, has been doubling every year. So it'll, if you go to 2023, it might be in a bit of a different spot. But yeah, what India is doing is really a fundamentally different model than what we have in the West, or really even what China has with digital payments. So it's called Unified Payment Interface, or UPI, as Alice mentioned. It was launched in 2016. It's now the largest digital payment network in the country. It processed $1 trillion in transactions last year. That's about a third of India's GDP. And the way it works, the government has set up a nonprofit that's partially owned by the central bank, and it basically sits in the middle of every mobile transaction in the country. So there are a lot of banks, a lot of fintech wallets in India, just like other countries. But what they've done is they've made them all talk to each other. It's called interoperability, where the UPI system sits in the middle of each one, and they have a common set of standards and APIs that allows for payments between my bank account and your bank account directly, facilitated by a fintech app in the UPI system. And so it's different than the West, because there's no need for a credit card network. And so, people who only have a mobile phone and may not have a credit history and might not be able to get into the financial system otherwise are now able to do digital payments. I think that's like a pretty big change for a country that was previously mostly using cash.
Yeah, I want to stay on that for a minute because one of the things that's so fascinating is how a shift towards these type of payments can unlock a whole range of other changes within the financial system as people have more data generated about their transactions. So it changes their credit worthiness, which in turn might change their ability to get insurance or loans. How is that playing out in India?
Yeah, that's a great point. So I think that's the real promise of digital payments, is what you get once people are doing the digital payments. And what happens, as you said, is you produce huge amounts of data. So both data on consumer spending patterns, but also from business perspective and cash flows into a business, and that allows for the provision of loans. And so if you look at India, loan provision has basically taken off. As a result of the data produced by UPI. They have a system where you can basically export your data. Let's say you're using one payment app or one bank, you can export your data. It's called the account aggregator system, and then you can import it into another, financial services environment. So basically allows you to kind of own your own data and then get, financial services from anyone. And I think that like kind of linkage between payments and other financial services is what's really taking off around the world. And I know we're going to talk more about China later, but it's really, they're the ones that really pioneered this model with Alipay.
Okay, well, hold that thought for a second, because I just want to ask you, Alice, a bit more about the bank account and card model that we have had historically in many rich countries, including in the West. And I'm struck by your comments earlier that in some ways the acceleration of digital payments during the pandemic in the West reinforced the position of the likes of MasterCard and Visa. And I'm wondering how resilient you think that model is going forward.
Yeah, there was a great line in Arjun's special report from one of his sources who said, the credit card model was invented, 60 years ago or something. Basically, in the 1960s was the sort of first time people started using credit cards. So it was sort of long before, even the internet or the idea of sort of digital payments ever existed. And the reason that model is so resilient is sort of partly because of, or the reason that I think that model will be very resilient is because obviously it has a huge network effect now. Every merchant in America is sort of signed up for the credit card rails. Those are sort of linked to the traditional banking system. And, everyone has access to these debit cards and credit cards through their bank accounts for the most part. And the more that people have started using sort of online payment methods or online shopping to purchase things, the more they've ended up, typing in their card numbers or using things like Apple Pay, which also runs on top of that sort of credit card and bank network to sort of use to carry out those transactions. And the reason that network is so sort of entrenched and so resilient is because it has an extremely sort of clever underlying model, which is that the card issuers, Visa and MasterCard, charge enormous fees to the merchants. The sort of shoppers, so your coffee shop or even sort of Amazon and Walmart. And those merchants feel like they sort of have to pay those fees. They have to accept these cards because they are so ubiquitous. Most of that fee is sort of routed to the issuing bank, so JP Morgan Chase or Citibank or whoever sort of issued the credit card that you're using. But they use that fee to then pay the consumers who use those cards sort of really enormous rewards. So this is the sort of air miles or hotel points or cashback that Americans have become sort of so accustomed to receiving. The cards also come with sort of huge amounts of sort of consumer protection. So, if something isn't delivered as described or sort of an airline cancels your ticket, you have recourse through these credit card companies. And they can afford sort of all of those luxuries because the fees are so high. And so it is very difficult to see sort of what could disrupt that model, because consumers love to use these cards and merchants feel like they have to accept them. Things are a little different in Europe, where regulators actually have capped the fees that these cards can charge, so that the system isn't as sort of lucrative and juicy there. And to an extent, you have seen more payment disruption in Europe, where sort of real-time bank payments have become sort of more prevalent than they have in the US. But no, I mean, it's a very well constructed system, and it's hard to see, sort of short of regulation, what could knock it off its pedestal.
Okay, so we have the newest model, I think it's fair to say, or one of the newest models in India. You have this 60-year-old model in America and Europe with the bank card system. And then in China, you have something different, right? Which is neither. You have a statistic in your report, Arjun, about how Alipay and WeChat control about 90% of digital payments in China. And I remember the last time I was in China, this is pre-pandemic, but trying to pay for something with my credit card. And it was even at a Western chain. I think it was a Starbucks. And they had to go to the back and get out a credit card machine and plug it in because everyone else was paying with their phones. And so tell us, for people who might not be familiar, what that payment system looks like and what its longevity is, you think, in China, or how it might be used elsewhere.
And the Chinese system is kind of a third beast. I'll get to that in a quick second, but just one thought on what Alice just said, linking to kind of UPI as well, is those network effects, as she mentioned, are really powerful, and that's what lets the card networks charge such high fees. And that was actually a key motivation for why the architects of UPI, and I spoke to several of them, why they designed it the way they did, which is they didn't want to have one or two dominant players sitting in the middle charging rents. They kind of viewed payments infrastructure as a public utility that should have low fees. So I think that represents a difference in philosophy. And so then let's go to China, which is kind of a third approach. And so it's not an open system like UPI is, but it's also not like a card network, how the US works. Rather, it's a fintech app or two, as you mentioned, Alipay and WeChat Pay, and they're closed networks. That means you can typically only pay from one Alipay account to another Alipay account, or from one WeChat Pay account to another WeChat Pay account. And the reason why the system kind of took off the way it did is because in 2011, Alipay, Ant Financial, they basically, at the time it was Alibaba, they basically launched a QR code system where you could basically scan a QR code at a merchant shop and then you could pay directly. And that was really groundbreaking because previously you needed expensive card readers, as you mentioned, which a lot of businesses in an emerging market don't really want to spend money on, which is why they would prefer cash. But QR codes are super cheap. You just need to slap a sticker on your storefront, and then you can start accepting digital payments. And by then, smartphones were becoming more ubiquitous. So that's kind of what allowed Alipay to really take off. And then WeChat Pay was able to basically copy it and grow because, WeChat was used for messaging, right? It's kind of like, as ubiquitous as like a Facebook is in the West. And so, everyone was already onboarded on their platform. So it was very easy for them to kind of already have the network effects built in and then simply add the payment business on top of that. And so just to give you some context on the numbers here, you mentioned the 90% of statistics, right? 90% of digital payments were happening on these two platforms. It's also a hugely valuable business because of the other services they put around the payment. So, Alipay Financial got really into lending, right? Right before COVID, something around 20% of all short-term consumer credit was originated by Ant Financial, which is, insane when you think about, how much money is going into lending in these countries. It was supposed to IPO for $300 billion, but of course that was blocked by the government. And in fact, the kind of presence of this type of dominant payment provider that controls so much of the financial system was a bit scary to the Chinese government, which is why they ended up doing what they did. And that was actually one of the motivations for why UPI was designed the way it was, is so the system didn't create such a huge individual player that controlled so much of finance.
Could I ask a quick question from one of our live attendees, Casey? How do governments think about taxation when you're talking about some of these digital payments? So in India with UPI, what's the system for tax?
Yeah, it's a great question. So, when it basically makes taxation much easier to collect. So, if you look at tax receipts in India, they've gone up a few percentage points in the last few years. And, there's kind of two things happening here. One is the adoption of all these digital payment rails. And the other, of course, is the GST, which is kind of a consumption tax that was launched all throughout the country. So there's kind of two effects. So it's maybe a bit hard to disentangle which is causing which. But I think most people in the country think that the digitization of payments does make it a lot easier for the government to collect tax because, of course, all the transactions are going through a nonprofit that's partially owned by the central bank. They can kind of make sure that businesses aren't avoiding tax. So as a result, collections have gone up. And I think that's a huge motivation for governments to digitize payments, is so they can bring more businesses into the formal economy from the informal economy, which is quite a big portion of economic activity in India.
May I ask, this might be one for Alice, but when you think about the experience of WeChat in China, why wouldn't we have something like WhatsApp in the States become a payment platform? What is the barrier there? And you hear the likes of Elon Musk talking about an everything app. People forget that China's so far ahead of us when it comes to e-commerce, right? You have these mega platforms that do all kinds of things, e-commerce, social media, entertainment, plus payments. So two questions in there. Could WhatsApp be a form an increasingly popular form of payments going forward, or something like WhatsApp? And then why wouldn't we have an everything app in the West?
Yeah, no, they're both super interesting questions. I think in terms of this sort of the idea that you could have these messaging based, QR code based payment systems in the US or in the West as well, it definitely is sort of feasible that those kinds of technologies could be rolled out. And certainly you've seen sort of basically every tech company under the sun sort of be interested in this in recent years. So Facebook has sort of launched its own sort of payment tool. It at one point was going to even try and launch its own sort of stable coin, essentially, its own sort of currency. It would have been linked to a basket of global currencies, and people could have used that as a tool to make payments. In general, I think that these options can be provided for consumers and perhaps they'll choose to use them. I tend to think that for all the reasons I described about why people like to use the credit card system, partly the consumer protections, partly all the rewards and incentives, it's hard to see people switching en masse to those kinds of sort of cheaper, lower cost messaging apps, because they're only cheaper and lower cost for the merchants. They're not necessarily cheaper and lower cost for consumers. And so I am sort of a little skeptical that that kind of technology would necessarily sort of take off in America in the same way that it has in China. In terms of the sort of everything app idea, I mean, again, I understand why sort of every sort of tech CEO wants to build this kind of app, because it is incredibly powerful. Once you have that data on people's sort of payment transactions and every sort of purchase that they make throughout their daily lives, you can do all kinds of things with that data, especially in China, where sort of privacy protection is not as rigorous as it is in other countries. And you can use that to do things that are very helpful for people, like make loans, or things that maybe are to the benefit of businesses instead, like sort of serving them sort of more specialized or targeted ads. And so I understand again why people would try to build an everything app for America, but I think that for a couple of reasons. One is that I'm not certain that that kind of messaging based platform will take off in quite the same way. And the other one being that I think even if it did, you'd have a lot sort of stricter privacy protections that would limit the ability of firms to sort of do what China has done with Alipay and WeChat Pay in China. I don't think it's sort of quite what the model is going to be here, but I certainly understand why everyone is sort of thirsty to build it if they can.
Right. I guess the last problem with it would be the attention of antitrust regulators, right, where they are already looking to rein in big tech. So the idea that big tech would become even more expansive could potentially be a hurdle. We have to talk about crypto. I'm sure there are many people watching who are eager to hear each of your views on that. And Alice, you've written extensively on this as well. It's been a really tough year, obviously, for the industry. You have the value of cryptocurrencies in total dropping by about 60% since its peak in 2021. But that still leaves a lot of crypto out there that's worth over $1 trillion. And Arjun, I'm wondering if you have a view of why people are holding on this year, holding on to crypto assets.
Crypto is the kind of, the question in the back of the room that, does it still have a use case? And I think there are a few persistent ones that we identified in the report that are what supports the 1.2 or 1.3 trillion dollar market cap, which is significant. And one is Bitcoin is basically been being used as a form of digital gold for a lot of savers around the world. This is especially true in countries where the alternative to crypto is really bad. And I think that was a key theme in the report is, crypto is greatest use when the traditional financial system is not really doing all that well. So in countries like Lebanon or Argentina, there's actually you see higher levels of stablecoin and Bitcoin activity in measures of crypto that various researchers have done across countries, and basically the reason is because if inflation's like 100% or even higher in Lebanon, then Bitcoin might actually have a positive return, and it might be easier to access crypto in some of those countries than it is to access U.S. dollars or other financial assets that might require a national ID in another country or an address or a bank account. And stablecoins, as a result, also have a use here. And stablecoins, of course, they're pegged to foreign currencies, so their value doesn't fluctuate. And so they might actually be used for payments in some of these countries with worse financial systems. And so there's some evidence for that as well in countries like Argentina. But I think the other broad finding from the report is that in countries with functional systems, very few people are using crypto for real everyday economic activity. It's mostly still in the experimental, R&D stage. Some people use it for trading and speculation. There's talk of it being used as, the financial infrastructure for applications in Web3. But in terms of, everyday people finding value, I mean, the fact of the matter is, crypto can actually be more expensive than, you doing a transfer with your friends on Venmo, or if you're in India using UPI, right? Because you have to move money from traditional currency into crypto, which there's a fee for that. Then you have to, settle the transaction on a blockchain, which, requires, performing some kind of consensus algorithm, which again can introduce fees. So, crypto, despite its claims for efficiency, is actually not as efficient as the traditional system in a lot of cases.
That's interesting. What's the effect of regulation on that, Alice? So the EU just passed a new rule that is going to take effect next year, the Markets in Crypto Act. Does that reassure investors? Does it make it more or less efficient? What happens to this industry as some of these regulations come into place?
Yeah, so regulators have sort of focused in on a few things in sort of drafting these bills. One of them is, as sort of Arjun described, is sort of stable coins, and making sure that if people say that their sort of stable coin is fully backed by dollars or assets, that it's sort of clear, disclosed, and that you can have sort of faith in that kind of promise. And you have seen a lot of sort of mishaps with stable coins in crypto, sort of most famously the sort of Terra Luna collapse in 2022. And then sort of on sort of all the other kinds of things that regulators are sort of fixated on in this space. So things like KYC, sort of know your customer requirements, and in general, sort of things that kind of make crypto sort of adhere to the same rules as traditional finance does. And, as Arjun's just pointed out, traditional finance, and in particular, sort of when you merge that or sort of interact that with fintechs, tends to be sort of pretty cheap and efficient and easy to access. The apps tend to be easy to use. It's very low cost to send transactions, all of those things. And crypto sort of is slightly in contrast to that. And so if you're sort of putting a lot of these regulations in place to try and make crypto adhere to some of the same sort of sensible standards as the rest of finance does, then it does become difficult to see sort of specifically what the use case is for crypto. I mean, Arjun mentioned that people like to hold Bitcoin as a kind of digital gold. This kind of regulation is certainly not going to deter that kind of thing. I'm sure sort of speculation and things like that will still exist. But in general, I think that some of the sort of rules that might be put in place might curb some of the sort of the worst behavior in crypto, but also some of the sort of functionality that has skated around the kind of traditional rules that and guardrails that are in place for regular finance. That said, people that I talk to in the crypto community are sort of pretty excited about Europe's MiCA Act, and they in particular contrast that at least they have some clarity in Europe in compared with the US, where there's become sort of quite an adversarial relationship between a lot of the big crypto firms here and regulators. Crypto here sort of say that they have no idea sort of what rules they're supposed to comply with, and that they sort of get served with these enforcement actions, and they're sort of not really sure how they could adhere with sort of traditional regulations. So, as much as regulation might sort of restrict some of the ways in which crypto is used, people are certainly sort of happier to have sort of some rules than no rules. As for whether they'll reassure investors, I mean, in some ways, they should. Some of these sort of, hopefully they'll curb some of the sort of illicit activity that goes on in crypto. But in general, I think that sort of what excites investors most is when the prices are going up, and they've been doing that a little bit more recently. But as you said, sort of still pretty down on where things were at their peak.
So one of the things that you've written about before, Alice, and that I'm really keen to hear, Arjun, your current views on, is not just regulation of digital currencies, but the creation of digital currencies by governments. So you see central banks becoming involved in backing different digital currencies. And so I wanted to ask about this, the direction of travel. A subscriber, Tom, asks whether central bank digital currencies, or CBDCs, still have any merit? What do you think, Arjun?
CBDCs are still very nascent. So, most countries are still in the pilot or exploratory stage for them. I mean, something around 100, I think 110, 115 central banks around the world are looking into them. Something over, 90% of the world GDP is covered by those countries. So a lot of countries are interested in it, but very few countries, less than 10, actually have, launched them or in full scale pilots. I mean, a few notable examples are, Bahamas, with the sand dollar, Nigeria with the e-naira, and then of course China with the ECNY is the largest pilot going on at the moment. But a lot of central banks are, kind of thinking about or questioning, what problem is this actually solving? And Neil Kashkari at the Minneapolis Fed has become kind of infamous for putting this question to a lot of his colleagues, and in a lot of cases, I think the answer to that question is not quite clear. And the reason why is because, as we've been talking about this entire conversation, a lot of money already is digital, right? Through the traditional banking system, through fintech apps and so forth. So the question is, why do you need to have a CBDC? And so just to offer a definition, like what is a CBDC? What is the core difference between, other digital currencies, between, money in your traditional Wells Fargo or JP Morgan Chase bank account? And the core difference is, whose balance sheet is your money a liability of? And what I mean by that is when you have money in JP Morgan Chase, really what that means is JP Morgan Chase owes you that money. So when you go and pay someone else, JP Morgan Chase has to go and settle a transaction with the bank of the merchant that you're paying money to. But with a CBDC, your money is sitting on the balance sheet of the central bank. It's basically the equivalent of dollar bills or pounds or physical paper currency that you can hold in your hand, which is backed by the central bank itself. So the core difference then, of course, is you're not exposed to a bank failure from your commercial bank. So I mean, in a sense, then central bank money is safer than commercial bank money if you think that your central bank is more creditworthy. Of course, the issue is if you did create a CBDC, and this is something that the three examples I brought up, Bahamas, China, and Nigeria are dealing with, is consumers might move all their money out of the traditional banking system into the central bank digital currency. And so what these countries have done is they put caps or limits on how much CBDC you can hold, because they don't want to disintermediate the traditional banking system, because of course the traditional banks have figured out ways of providing other financial services like credit to the economy, and central banks don't really want to have to deal with that because it's a very difficult problem. And so you're kind of caught in this in-between zone where you don't want to make your CBDC too good, but you do, if you have a cap on it, then of course it becomes less useful. So I think countries everywhere are trying to figure out what is the right balance to strike, what is the problem we're trying to solve when the financial system is already highly digitized. I think that's still a work in progress.
Alice, could you talk a bit about the thinking among banks? So Arjun just described some safeguards that governments have put in place to limit the competition actually that banks would face from these government-backed digital currencies. But do they view it as an actual threat to them? Is this something that could be seen as really disruptive, or are they relatively feeling sanguine about it?
When you tend to talk to bankers, they sort of tend to say that they don't really think that these sort of CBC tokens are necessary. And of course, that is what they would say. They are, as Arjun has described, this sort of rival payment instrument and sort of rival form of money that in many ways would be more appealing. Again, for all the reasons Arjun described, occasionally commercial banks fail, as we've experienced in the US, and I guess in Europe recently, whereas the sort of central bank is the sort of most sort of sound and safe place that in theory someone could keep their money. So banks have never been keen on CBDCs, and they sort of retain that position sort of the entire time that I've been sort of covering this idea. I think what has changed, and this is sort of partly getting to what our listener asked and sort of what Arjun was talking about, is the sort of urgency with which people think these CBDCs might be needed. So there are sort of two main sort of reasons that people were sort of getting excited about potentially issuing these things. And one was that as cash goes away, it becomes increasingly difficult for people who are unbanked or people who are the sort of poorest members in society, essentially to interact with society. And in China, that's kind of fine because most people still have sort of very, you can get sort of pretty cheap smartphones and then you can pay for things on QR codes. And so perhaps, digital payments sort of growing in importance and clout in China actually is something that sort of makes them more accessible. But in particular, the sort of Swedish central bank was sort of very fixated on this question because merchants in Sweden and in Stockholm sort of stopped accepting cash entirely. And so if you are sort of one of the sort of people in Sweden who is sort of too poor to have access to a bank account, there is now a problem in terms of sort of how do you use money if no one will accept cash anymore? And that was sort of the problem that they were really fixated on solving. And that is a problem in America. Actually, sort of something like 7% of Americans still don't have sort of full access to banking services. So if cash goes away and merchants stop accepting it, you have that sort of problem. And that's something that sort of banks don't really have to worry about because they're sort of thinking about the sort of banked customers. And the other reason was that there might be a sort of potentially bigger threat from tech. So, when Facebook was potentially going to issue its own sort of money and people would have been using that, people were worried that that sort of might displace essentially the sort of monetary sovereignty of certain nations. And the banks also would have been extremely sort of concerned about that happening as well. And as a result, sort of basically all regulators told Facebook that they couldn't sort of issue Libra in the way that they wanted, and that project has sort of slowly died. So, some of the threats to sort of banks and central banks, they're sort of they sort of both don't necessarily want tech sort of muscling in the same tech muscling in such a way that it might sort of harm those kinds of existing systems, but. Yeah, in general, banks aren't keen, and I don't think that's probably going to change.
So we are going to take some questions from people watching, but before we do so, I'm going to make a quick plug for a project from our colleagues in Economist Films. Together with Arjun, they've taken a look at what might be in store for the future of crypto, and the QR code, which is on screen now, should take you straight to the page where you can view it after this event. But we have a question from Zara on economic sanctions, which is of great interest to me, and I'm curious to hear each of your thoughts on this. The question is whether the digitization of finance will help or hinder the imposition of economic sanctions. So I will add my own question to that. Russia used digital finance in part to reduce its dependence on the dollar and on SWIFT in the wake of the invasion of Crimea, which has been useful to them this time around as more sanctions have been imposed. So could you talk a bit about that? How does this trend that you've described of a shift towards digital finance, how does it affect the dollar more broadly and the efficacy of sanctions?
So I think we should let's start with domestic payments, and then we'll move to international payments. And that gets to what you mentioned, Charlotte, which is after Russia invaded Crimea in 2014, the Western card networks, Visa and MasterCard, temporarily pulled out, which, of course, hampered the domestic economy. So Russia launched a new card network of its own called Mir, which has grown quite fast. And so this time around, when it invaded all of Ukraine, its domestic payments infrastructure was quite insulated. So I think the key point there is that countries have, made investments in kind of nationalizing or providing a national option for digital payments domestically, which means they're no longer as dependent on Western financial infrastructure. And so this is not yet about the dollar. This, so far this is just about, the rails or the system you're using to send money. But the point is that sanctions have, perhaps become slightly less effective as a result of countries building out their own payment options. UPI has a similar motivation. China has all but kicked out Visa and MasterCard. They have their own card network called UnionPay, which is almost as large as Visa now. So all these countries have basically found ways to be independent domestically. Okay, so that's one part of it. The second part of it is on the international payment side, which is, gets you more to the debate about the dollar. And I think, we should be a bit careful here because there are multiple reasons why people, save in the dollar, why the dollar is the world's reserve currency. And some of them have to do with digitization, and some of them are completely independent of digitization. So, a lot of people invest in dollars because of what's called, an open capital account. So if you invest in America, generally you can always, pull out of your investment. There are no regulations around that. And so that lack of capital controls, makes it, gives investors some types of an assurance over their funds. Whereas in China, for example, they don't have an open capital account. They actually had, a currency crisis, in the mid 2010s that scared the central bank of China from having an open capital account. So they started imposing harder controls. That's a big reason why the Chinese yuan actually hasn't really grown all that much over the last decade. That being said, even if the dollar retains its position at the top of the currency pecking order, I do think sanctions are perhaps less effective now than they were a decade ago, and that's because internationally there have been more payment rails that have been built out. So again, sticking with China, they've built what's called the China Interbank Payment System, or CIPS, which is both a messaging system, so an alternative to SWIFT, which is the dominant messaging system based in Brussels. And just for those who don't know, for any payment, there are kind of two parts to it. There's both the messaging, where you send the information about what you're going to do with the payment, and then there's the actual settlement, where the money actually moves between banks. And so CIPS can do both of them. And it does settlement in Chinese yuan. And so it's actually doubled in transaction value over the past 2 years. And a big reason is because, Russia has been, locked out of many Russian actors have been locked out of the US banking system and SWIFT. And so they're using CIPS as an alternative. And so even though the dollar is still dominant globally, this is basically an example of how perhaps the power it confers has been reduced a little bit. So hopefully that gives a bit of a sense.
Alice, do you want to add anything to that? I know you've thought a lot about this. Anything you want to add, or shall I move on to the next?
The only thing I would say is that I sort of mostly agree with Arjun. It's very hard to see how you could it's much harder to make the case for the yuan being sort of the global reserve currency in the same way that the dollar is, for all of the reasons that the dollar is so attractive. But it's much easier to make the case that he's made, that, you might get some competition in these sort of cross-border transaction services. And I think, one of the things that is interesting and sort of is an incentive for countries to work on CBDCs is that they provide an additional sort of form of competition for those cross-border payment rails. So what sort of China has done is sort of with one of its wholesale CBDs, it sort of linked it up with various countries in Asia through this thing called a bridge. And that would be another way, sort of another rival cross-border payment system that it could use that would get away from the sort of US-dominated correspondent banking system. The US is sort of aware of this and does seem to be reacting. The US has launched its own sort of wholesale CBDC bridge pilot program with Singapore. So it sort of doesn't want to be left behind. And I think that more than anything probably shows you that this is a sort of real threat, essentially, to its sort of dominance of the sort of way that transactions and money moves around the world. And you can think that, it's going to lose its clout without thinking that the dollar is going to be dethroned.
Okay, I think we could talk about that for a lot longer, but I have a very good question from Jonathan, which is about the role of public investment. And so much of this conversation, of course, is about how public investment and public regulation interacts or facilitates or restricts this huge amount of activity within the digital payment space. But Jonathan's question was about the role of public investment and the importance of it in digital infrastructure that then catalyzed the use of digital transactions in India. So the question essentially, Arjun, I think this is one for you, is if other countries want to replicate the experience of India with UPI, does it require huge public investment to do so?
India is still grappling with how exactly to design their system, though it's been very successful. And they are in talks with 30 other countries to export their technology. So very, very relevant. I think there is a big role for public investment, because I think what India's UPI showed is you can kind of get around this network effect problem if the government serves as a central coordinator that's sitting in between all these different transactions. And if the network is open, then you can kind of get an interesting public-private sector dynamic where private actors have an incentive to onboard consumers. So of course, in the Indian system, any fintech, whether it's Google or WhatsApp, with their payment apps, they can onboard consumers and link their bank account to the UPI system so they can make payments. And of course, because they're using QR codes, it's very cheap to do so. So I think, but having that government institution in the middle was pretty critical to serve as a central coordinator. I mean, the flip side, of course, though, and I mentioned this a bit earlier, is India's system is currently free, so it has zero fees. So the banks and the fintechs, as we speak, are a little bit annoyed that they're not getting compensated for maintain this important infrastructure, and so you do need to have some kind of economic model. I think there are a lot of discussions in India right now around how exactly to design that. You don't want it to be as high as it is in the West, or sorry, in America, where the fees on credit cards are something like 2 to 3%, but you also don't want it to be zero, where perhaps there's a lack of incentive to invest in customer protection. If there's fraud conducted against you, you can't get your money back. And that's one of the reasons why UPI is primarily used for low value payments. People, prefer not to use it for high value payments because of that lack of customer protection. So I do think, when you put the government in a very central role for public infrastructure, that of course can lead to these types of risks. So, I would say public investment is pretty critical, but it has to be, it has to be done with care.
Okay, we only have time for a final question to each of you that has to be relatively brief, unfortunately. But Alice, what do you think is going to be the most disruptive element of digital finance in the next 5 years? I know this is hard to pinpoint one thing, but if you had to, what would it be?
Gosh, that is a really excellent question. I think it probably will be some sort of tech company based innovation. I guess I won't necessarily pin my flag to the mast saying exactly what that will be, but I guess what we have described is sort of three kind of models for how payments might change, and one is crypto, one is this sort of government system, and one is the tech based system. And so I'll sort of slightly hedge and say in America, some sort of tech based innovation will be what really changes things, because I think that America is sort of much sort of more sort of cautious and slower about sort of introducing new technologies like CBDCs, like sort of government-based systems. And so I envisage that it will be some sort of tech industry innovation that will change. But things might be different in the rest of the world. And with that hedged answer, I'll pass over to Arjun.
Well, I think what Alice said is absolutely true. In the West, I think for me, maybe I'll focus on the emerging markets, because that's where I was, just leaving off. Which is, I think what UPI has done is already started to, and of course, what really China with Alipay did, and actually, if we were to go back even further in history, with Kenya, with M-Pesa, and Safaricom with mobile money, this emerging market digital payments revolution is not yet complete. There's still a lot of countries that are still highly cash dependent. And over the next 5 years, we're going to see even more adopt these types of systems. We talked about Brazil's Pix earlier. They've taken inspiration from UPI, and they launched in 2020. And in just 2.5 years, it's already the dominant digital payments option, processing, I think, around 30% of all payments in the country that are done electronically. And these types of things are going to keep getting built out. More and more countries are going to adopt this technology. And I think that's going to be a huge transformation for emerging markets in terms of their growth, ability to access credit and financial services. So yeah, that's where I would put my prediction.
Thank you for watching. If you would like to see more about our upcoming subscriber events, please click the link. And on that same page, you can see recordings of prior events, including one in which we talk about the risks and opportunities of generative AI. See you next time.